Hello, everyone. How's Berlin going?
Excellent.
Very nice. Thank you guys for having us.
Absolutely. I hope, Emilio, you're fine among two merit diluters.
Yes, absolutely.
I thought we could start off, maybe you guys can give an overview as a user. Of course, you guys are all three lending protocols. Are you guys like targeting the same users? And maybe you guys can like highlight what the main differences are of what your protocol might appeal to different users?
Yeah, sure, I can start with this. So I would say actually we're a little bit unique in this in that we're not so much a specific lending protocol, but as under Spark, it's more of a liquidity provisioning for Maker and DAI. So in that sense, we can use multiple markets. So we've even lended in the past to Aave v2, Compound, and now more recently Sparklend, which is the Aave v3 fork, and now we've lended to Morpho as well. So that's a little bit of a difference between us, I think.
Yeah, I mean, pretty much Aave v3 and the Aave protocol has been like one of the, it is currently the largest protocol by TVL. So users that use Aave, usually they look for leveraging options to leverage their own collateral or to earn yield in a very simple fashion, where users can just supply liquidity, whether it's USDC, USDT, DAI, ETH. The latest protocol iteration has a lot of features that allow even long-tail assets to be supplied safely and to be used as collateral in a safe way. And yeah, it's been a great journey, 5 years of grinding and innovation, and we recently announced before. So yeah, like we keep moving forward.
Awesome. I think Morpho is a bit different design by principle, right?
Yes, exactly. So maybe it's worth mentioning that we have two protocols. So initially, we were actually built on top of Aave and Compound, so some kind of optimization layer on top of Compound and Aave, providing like better interest rates with like similar guarantees and similar users. With Morpho Blue, which is the latest protocol, is very different approach where the risk management is externalized from the protocol. So the Morpho Blue protocol is very primitive. And so therefore, and it's also permissionless, so anyone can create the pools they want, etc. So it addresses a user base that's much more advanced in the sense that they have to know how to do risk management, right? And so in practice, it means risk managers, like, directly using the protocol, or DAOs that are, like Spark, like building like lending products on top, right? And so as you move into the abstraction layers on top, then we target like similar users to Aave, where, obviously you have the lenders, okay, excess of capital want to generate interest, and borrowers, okay, want to leverage on some collateral that you have. I'd say the main difference is that we're probably able to like target a broader set of assets. But we're obviously much smaller than Aave v3, so we can, we kind of like larger users tend to prefer like Aave v3, which has like larger liquidity at the moment.
Makes sense, yeah. I think the risk management is probably one of the big differentiators. I think, Paul, you previously said that Aave is a financial product and broker, while Morpho is more of an immutable financial infrastructure. Do you mean this because of the active risk management, or is that like one of the components of it?
Right, so like we have this mental model of like distinguishing protocols where, platforms where the risk management is enshrined inside the platform, in which case, you have the DAO essentially taking risk decisions to connect liquidity and to set risk parameters, quite actively, so users don't have to. And this is what makes, Aave or Sparklend, very good products. Like users don't have to really think. They deposit their money and they're, fairly protected in a decentralized way, by the way. So like, and while the Morpho approach, pushes this complexity back to the user, which has some upsides and some downsides. Downside being, okay, they have to be active and they have to be knowledgeable. And obviously the upside is that we can target more use cases. It can become like immutable and permissionless. And then on top, you have those decentralized brokers that can be rebuilt on top, right? So like reaggregating liquidity and doing risk management, et cetera.
Makes sense. Do you guys agree with the
No, I disagree with that view. I don't think that Aave or the Aave DAO act as a broker or as decentralized fund. I think his main point regarding this topic was risk management and upgradability of the contracts. So it is true that the Aave DAO manages the upgradability of the contracts. The upgradability of the contracts is not used to manage the funds, of course, although there is the potential for the DAO to do that, but there is nobody in Aave actually managing funds or moving funds around or deciding, like if we go to the actual meaning of a broker in real life, a broker is someone who does reinvest eventually capital or applies investment strategies to capital that someone else supplies, which is not what happens in Aave, because everything is algorithmic and pre-programmed, so the rules are on chain. Rules can change, of course, through governance eventually, but the upgradability of the contracts is not really used for that purpose. One of the things I want to clarify is that the current deployment of Aave, the biggest deployments of the Aave market, the protocol doesn't necessarily need to be deployed that way. The way that currently is functioning is one of the ways that the DAO, through trial and error and through years of experience, found that works at the moment and scales. But it's not necessarily the only way. The protocol is quite flexible, so if an immutable instance of the market for certain needs is required to cover certain needs that the main market cannot cover, it's perfectly possible to do that. So I don't think that Aave acts as a fund or a decentralized broker, and I do believe that at least the immutability will be targeted pretty soon, because we all believe as well that the ultimate goal of a decentralized protocol should be immutable. That's the ultimate target for a decentralized protocol. And also with V4, there will be a completely different approach to risk management, which will further reduce the need for the governance to intervene while keeping the same trust assumptions. So, yeah.
Yeah, I'm going to disagree with that. So I think Aave and Spark as well are absolutely the risk managers of the funds that are deposited into the protocols. So we are managing where the cash balance is going. It can be more indirect in the sense that you're onboarding a collateral and then users are taking leverage. But fundamentally, the backing of something like AUSDC or AUSDT or DAI is decided by which collaterals you're onboarding. And in the sort of extreme, and it's really just the amount of leverage you offer. So as you go to infinite leverage, you approximate something that looks more like the protocol directly investing into something, but it's really sort of more of a gray area of where you go. So if you're at like 99% LTV, you're effectively allocating funds into something, and the backing of the deposit token is the decision of the DAO has been made to go into this asset, that is backing the deposit token. So in that sense,
the users, like if a user doesn't like an asset that is listed on Aave, they can easily withdraw and go somewhere else. So
for sure, but you are opting into the Aave DAO doing risk management. Would you agree with that?
Yeah, I do agree, but I don't consider that a brokering strategy.
Whatever I don't care about the terminology, but yes, you're doing risk management on behalf of the users.
Okay.
And same with Spark and Maker.
Yeah, but that's undeniable. I don't think that accounts for brokerage. That's my point.
Okay, whatever the term broker means, I don't really care.
The term can be discussed, but we can agree that, even though, the Aave, for instance, could become immutable if we remove the upgradable proxy and the logic becomes immutable. What's most important here is like the parameterization of the risk, and this can be managed by the DAO, which we all agree.
And in Morpho, it's all isolated, the lending positions, right?
Right. So on Morpho, like the core market has like a specific risk, right? And then it's an opt-in for people managing risk on top of Morpho to decide to allocate a portion of their funds or their capital, into this specific market, exposing users to this specific very primitive risk. So it's much more primitive than the risk you get exposed to like on a compound or an Aave. It's like one collateral, one rate, and one oracle, for example. And gives you much more flexibility, and maybe we can talk about what we've been doing with Spark and how they've been exposing DAI to SUSDE in a fairly senior tranche way.
Yeah, for sure. I mean, I think USDE has been a big topic over the last few months.
Maybe I can get into that, like why we chose Morpho for this specifically.
Yeah, absolutely.
Because I think it highlights some of the limitations of Aave v3 and really just the compound design where everything is pooled together. So originally when we were wanting to onboard Athena as collateral because of the risk-adjusted yield is just a very good opportunity right now due to the bull market kicking off. So we were looking, the default was of course to use Sparkland, right? We want to use that, it's available, it works really well, high quality code, so we were gonna use that by default. There's kind of two main problems with the limitations, and one is that the borrow rate. If we were to onboard this collateral, either you allow users to borrow at the, roughly the DAI savings rate, a little bit above. It's the same rate that we would offer to say users who are using ETH, right? So ETH is like borrowers are taking leverage on ETH. They get this, 8-9% rate. But if we were to offer the same rate to people who are taking USDE leverage, it would be seeding way too much money it's like too good of an opportunity for the person who's taking leverage. So Maker wants to capture most of this value because Maker is the one LPing into this. So with Morpho, you're able to, the markets are isolated. So we can offer a borrow rate that, sometimes they're 30% because of the high yields. Maker captures way more of this value, and then it wouldn't crowd out the existing borrowers on Sparkland who are enjoying, this more 8-9% rate if they're borrowing with a high quality collateral such as ETH. So this allows us to capture more value into the protocol, and then it segments the risk. And so as Maker, it's a little bit different as a regular LP, where you have this opportunity cost with idle capital. So you have to pick this market and be okay, I think there's going to be demand here, so I'll put my USDC in here. With Maker, Maker can just mint DAI into these markets, and they're available on demand. So there's no opportunity cost for holding DAI. So it's really not a problem for us to support every lending market because Maker does not pay a cost to that, and we're able to meet the users where they are. So in this particular case, it turned out that Morpho Blue was a much better market to facilitate what we needed.
I pretty much agree in the sense that for this particular use case where there is unique individual single entity liquidity provider, like in this case Maker, you have the capability in Morpho at the moment to segregate capital better than what you can do in Aave v3. It's of course going to get addressed with Aave v4. We have a wide series of features that will allow to do pretty much what was done with Morpho Blue using Sparkland vaults with v4, while maintaining, avoiding segregating liquidity. I just want to say something regarding risk management. It was mentioned before, because it is true that the Aave DAO is doing a risk management on behalf of users, but and it is true that Morpho Blue pools have immutable risk parameters, which might be debatable if it's on the long term, if it's a great choice or not. What I want to highlight is that there is still risk management, whether the parameters are immutable or not, because what's going to happen, for example, we have been seeing with the Gauntlet Vault on Renzo ETH, that if a market is deemed too risky by vault managers, which is the primary way liquidity is applied to Morpho Blue, what happens is that a risk manager will probably pull the liquidity out of the pools that are riskier, which means that the borrowers that are borrowing from those markets will be subjected to higher and higher and higher rates until the outcome is either they rebalance to a less risky pool or they get liquidated. So the outcome for the borrowers and the users is basically the same, with the aggravating circumstance that you are actually gonna get paid more in terms of, get charged more in terms of borrow rates. So the outcome, I would say, whether is the DAO managing the risk parameters or risk providers built on top manage risk parameters is pretty much the same, but there are trade-offs on both solutions, in my opinion.
On this poll, I know Morpho is like positioning itself as like a risk management marketplace. With the Renzo liquidation that happened that Emilio just mentioned, do you think like users acknowledge this differentiation between protocol and risk management platform?
Right, so obviously, like, it's very hard like to get the message out that, protocols are fairly different in the way they're structured. But I think, it's starting together. Like, people understand that on Morpho Blue, the protocol is permissionless, and I think in the day we deployed Morpho Blue, like really few hours after, we had the first scam markets created. Like, someone was already, like on Uniswap, you get like many scams, every day like created. And so obviously, it's really a different paradigm in the sense that we don't, as a DAO, we don't guarantee anything to the user in terms of, the risk they're taking on the specific pair, because a pair could be anything, really. And so lenders, some lenders, they are fine with that, and they, do their own risk management. Most users, usually they want to delegate that responsibility, right? So they usually, use the second layer of Morpho, which is called Metamorpho, which is used for many different things, including doing risk management, reaggregating liquidity, arbitraging rates, et cetera, et cetera. And so as a lender, you would go through this layer if you want to be passive, right? As a borrower, you're still using the primitive as of now, right? So like the raw primitive. So you have to make your choice between the different set of assets. And obviously some assets are here, and you're taking significantly more risk using the easy ETH USDC pair than if you were like borrowing USDC with BTC on Aave v3. But Aave v3 does not list easy ETH because it's more risky. But some users do want to use this, right? And then they acknowledge the risk and go for it still. So yeah, and I think that's just like simply part of the design, essentially.
Makes sense, yeah. And then just coming back to USDE, I know Aave was also very critical of like the large exposure Maker was kind of getting with the Morpho allocation. I think it's at 350 million now DAI, potentially going up to 600 million. Yeah. I think like Aave is now also onboarding USDE, right? There's a snapshot passing. Do you see that like differently, or is it like smaller amount, or?
I think like most of the concerns, at least on my part, there were many voices when this started. The main concern, at least on my part, was neither that they were using Morpho, or the main concern for me was that Athena is a quite new design. It's untested. It's been growing massively on the initial bull phase on this market. It's, in my opinion, a protocol that works much better in a bull phase than in a prolonged bear phase. And my main concern was if I just didn't want to see the space exposed to strong systemic risk, which, in my opinion, at the moment seems quite conservative. So I don't particularly have strong concerns around it. And I think there was no, it was pretty much public information, was on the forum that Aave was going on board USDE at some point. Yeah. And this is just a natural evolution of this proposal that was created a few months ago. I think like already some time passed as well. They kind of sustained already the first strong market movement downward with relative ease. So I do think that if we are careful enough, like this thing can scale further.
Makes sense. And were the DAI parameters adjusted on Aave? I know there was a lot of discussion around that.
I think just the LTV, but slightly.
Okay.
Yeah.
Makes sense.
Yeah, so for Athena, I mean, maybe from the outside it looks like we're just YOLOing money into stuff, but like that's not at all what happens. Like there is like deep risk analysis of the entire structure that was done for many weeks in advance, and then there was a controlled ramp up. So like some people were throwing out the number, 1 billion or whatever, but as you said, the exposure, it's been 2 months and the exposure is 350 million, which has been ratcheted up as we see things are proceeding well. So and the other thing to keep in mind is like this is not direct investment by Maker. These vaults are over collateralized, and so when you do this risk analysis, sometimes it can be like counterintuitive, but really you just kind of have to dig into the numbers, figure out what are the likely scenarios where there could be insolvency, and just set the parameters accordingly. So yeah, it's been fine so far. It is definitely a product that's going to thrive in a bull market, but there's the analysis is done, and even when there is a switch to the bear, these positions can just unwind. At most, you're dealing with slippage, getting in and out of these perps products, but we're not talking about catastrophic losses in an extreme scenario. We're talking about a couple percentage points of potential losses in extreme scenarios, and this is precisely why the Athena team has built their own internal insurance buffer. There are many, many, many layers of protection protecting DAI holders, and this is the advantage of being in the DSR. You get Athena's insurance, you get the over-collateralized vaults, you get the maker surplus buffer, which is 50 million DAI, plus 160 million in protocol-controlled value that is in this Uniswap pool. This is all protecting DAI holders such that they get the best risk-adjusted yield in DeFi at scale.
Makes sense. I guess Morpho's quite happy with these as well. I think it's like 60% of borrowed assets come from this Spark Vault, right, or Morpho Blue at the moment?
Right, so happy, so one thing to clarify is we're different than having the structure, but also in the revenue model and how we think about revenue generation. So currently we're not generating any fees on any of the protocol that is created. So we just have a fee switch that is turned off. So yes, we're happy to have activity and volume on Morpho, but we don't have any financial interest directly related to this. And it's fair to say that so Morpho Blue is actually quite recent. It's like 4 or 5 months old, and that does represent a large proportion today of the activity there. But all the other use cases are growing quite rapidly as well. So yeah.
I have a question for him. Can I?
Sure.
How do you plan? At the moment, the returns on this market are quite small related to the risk. So these protocols usually manage relatively high capital. The return is not particularly high for entities that created it or manage it. So at the moment, most of the return is captured by risk providers on Morpho, as far as I can tell. So how do you see, given the small margins, how do you plan to make this competitive, given that you already have part of the returns going to risk providers?
Yeah, it's a good question. So I guess the main thing here, the fee switch in Morpho is tied to the license, right? So what happens, so the current code of Morpho Blue is a BUSL license, but as soon as we turn on the fee switch, it turns open source, right? So it means that as an infrastructure, if we start generating some fees, but we don't create value, then people will just fork the protocol, and just change and move to another instance just because they're not happy with it, right? And so how do we create value is the question. Well, I think as many protocols, in general, we create value by bringing together lenders with borrowers in a common place, right? And so essentially, you come to Aave v3 and not an Aave v3 another instance of Aave v3 for the state of the smart contract, so liquidity that's in there. And it's the same thing for Morpho Blue. So on Aave, you get the state, but also the risk management. In Morpho Blue, you get the liquidity and the risk management, so state, and those two are, in our opinion, two different fee revenues, right? So risk managers get paid for their risk management, and the infrastructure gets paid for the network effects, liquidity that comes here, and because you have network effects, you're able to charge a revenue. And I agree, it's fairly small, right? And it only works at scale. And it's very similar to the Uniswap approach, where frankly, if this Uniswap starts activating fees and the license has turned open source, well, people will start building forks. And if you look at the Gauntlet study that was done on the Uniswap v3 fee switch, if I'm not mistaken, well, they actually price this, the value of the network effect. And so same thing for Morpho, essentially.
Yeah, I just see, with thin returns, having, the risk managers embedded into their flow of revenue, because, you mentioned Uniswap, Aave and Morpho are already similar in the sense that we have liquidity providers which receive fees in case borrow interest, and there is a small part that goes to the DAO, for example, in the Aave case, And in that case, there will be DAO risk managers and users. So there is another entity in the middle. That was my question, but.
So I'm not sure to get this. So on Morpho, you get the DAO fee and the risk manager fee, which by the way is optional if you know how to do risk management,
yes.
Right? I'm not sure to get how this is different from Aave. Like Aave has to pay for like DAO operations as well as for risk managers, and then maintenance for upgrades and everything, which by the way we don't have.
Yeah, the difference is that we decide how much like the risk managers get.
Yes, and so I would say, so in the case of Aave, the DAO decides. In the case of Morpho, there is like an open market, right? So like risk managers can compete with one another. It's not a one size fits all model where you essentially, if there is like huge network effect in the instance, the DAO will be able to charge fees, and risk managers are pressurized, essentially in the sense that there is an exclusive contract, they need to get it, and they're put into competition for this. While on Morpho, risk managers are directly aligned with users, and essentially they charge according to the volume that they get and according to what the free competition is doing. So obviously that should compress fees down. It's already the case. Like if you look at the fees on Morpho, they're really, really tiny for risk managers. So yeah.
Cool. Sam, one thing I wanted to ask, last year everyone was launching a stable coin and carry trading SDAI if the interest rate was low. Do you think we'll see this trend continuing? And I know Maker is also doing some changes with DAI. There's some new stables coming. It's just a rebrand of DAI. Maybe you can give some insight into that.
You mean for like borrowing DAI, the carry trade into like higher yielding opportunities?
Yeah.
Yeah, absolutely. So like, I mean, these people, they post collateral. This is a great use case for like Sparkland and Maker Core Vaults. And like people can post collateral, and if there's opportunities elsewhere in the market, they can borrow DAI and then, take that rate arbitrage. So yeah, that's like been a big use case of Maker for a while. So yeah, I think it definitely will continue.
Yeah. I think one of the stable coins launched last year was Go, right? Which struggled a bit at the beginning, now is back at peg. I think the Aave DAO started investing a lot heavily into Go. Curious to see, it's been a lot of effort and investment going into it, a lot of emissions. What's like kind of the vision? I saw Go is also like a big component of Aave v4. It's like much more integrated. Can you give us like an overview of like the vision of Go in the future and how it's being built out?
I mean, it's my personal vision, not necessarily the vision of the whole DAO. Personally, I think that Go can be a pretty strong component of the DAO in years to come. Some of the features of V4 are like to more tightly integrate Go with the protocol, because I personally believe that by doing so, we can provide benefit to the users. So for example, receiving interest in Go when Go is strongly at peg like it is right now, can, for example, the DAO can benefit from having Go injected into the market in different ways. So by doing that, you can provide benefits to the users that are actually supplying stablecoins by, for example, charging less from a revenue standpoint. So there are some benefits regarding some stuff that we can do that we could not do before Go, like for example, a soft liquidations, which is a mechanism that was introduced by CRV USD, something that some people think that should be built on top, which is possible, of course. Aave actually already has, through integrators like DeFi Saver, there are some automatic repayment features or automatic collateral exchange features whenever the market is going down, for example. And they work great. But we did some analysis on CRV USD, and the fact that it's integrated at a lower level into the protocol makes it possible. Sometimes users even profit from the application of soft liquidation to the protocol. So this is something that without a stablecoin you couldn't do it, basically, because stablecoin is generated on the fly whenever such a transaction happens. So there are quite a few benefits of having a stablecoin for a protocol like Aave, and I do personally think that it should be a strong driver moving forward.
Cool. And Paul, will we see a Morpho stablecoin coming soon, or?
No, it's not. It's not. At least it's not something we were considering right now. I think, to be frank, like the way we're approaching like DeFi lending is, I think everybody guesses like fairly different approaches, and I think the Aave approach is actually very close to what you, in terms of like engineering and operations behind the scenes, is very similar to what you need in order to get, the decentralized management of a stablecoin, right? So it's very natural for me that Aave came to like do, the GHO stablecoin, but that's. Like, again, we position ourselves like, like the base primitive lending market. So, it would make much less sense in our position. Even though, like, again, it's quite a lucrative activity.
Give them 5 years of development and they will come.
I want to comment on the stablecoin thing a little bit. So, like, I think there's this, like, magical, like, thinking that, like, stablecoins are these magical things that just can yield all kinds of return. And that's really not the case. Like, really, a stablecoin is fundamentally a tokenized deposit into some lending apparatus. And so whoever's dealing with that, that's details. But it's like a tokenized bank deposit, but on chain. That's essentially what a stablecoin is. And the vast majority of stablecoins are actually not revenue generating. They actually cost more than they end up providing. Because you have all this like cost with bootstrapping demand, keeping it at peg, that costs money. And so most of the time, these protocols are using incentives to maintain the peg and boost the supply at the same time. This takes the form of token rewards on like Curve or wherever else, right, where they can boost the demand that way. And like this is even true for DAI. So DAI actually emerged in this kind of nice period where it got this bootstrapped demand right off the bat, and it's sort of been coasting a little bit off of that. But since then, the competition is just extremely fierce. So Tether is completely dominating this space, and they continue to consolidate their lead. And so even like Circle and DAI as the next largest are struggling to maintain this thing. The natural tendency is things to just centralize and consolidate. So the value prop that the stablecoins need to offer is offering more and more yield to the users. This is the only way you can really fight demand in sort of a sustained way, and finding more integrations and stuff like that. So it's really like it's an uphill battle, and like even if you're well established, like it's really tough. Yeah, so it's an interesting part of the space. Yeah.
Cool.
I don't think it's. I agree with him on the fact that like it's really hard to grow and maintain a stable coin. I think that's pretty much true for everything. So like even Aave at the beginning, to get the position where Aave is in at the moment, like there was a lot of work around doing that, incentives, of which DAI also benefited at the beginning. Like in my opinion, DAI as a decentralized stablecoin has huge big mover advantage because like they managed to benefit from incentives from basically all the protocols that launched during the DeFi summer in 2021, and that's big in the sense that that's a great driver, and replicating that is really hard. But I do think that that's the reality with almost everything. So like at the beginning, you need to invest to actually be able to grow. So I do agree that it's more costly actually, but I see it more as a future investment rather than expenses.
Makes sense. And one question I wanted to ask before we finish is something I'm not quite sure of, Sam. You guys forked Aave v3 when it was MIT, but you guys have an arrangement with Aave DAO where you guys pay them something, but the arrangement changed because you guys were not happy with the arrangement. Or like, there's something going on, and like, can you guys give some clarity on what the arrangement is or what's going on?
Yeah, for sure. I mean, so that original deal was crafted in February, and at that time we were kind of just moving fast and getting stuff done. So we put some stuff down in the arrangement that we thought kind of made sense at the time, but things move fast in DeFi, and so the arrangement was adjusted after the fact that it wasn't yielding money right away, and we felt that wasn't quite fair. So we adjusted the arrangement to be actually paying Aave DAO for the 2-year period that it runs. And right now, it's on track roughly to be covering about 15% of the cost to build Aave v3, which was, I believe, $10 million that was paid for that. So yeah, about 1.5 million. And you know, it's open source code. I'm a firm believer that people should be free. We release all our code open source. Anybody can use it, compete with us, whatever. So this was an added bonus on top of it. We felt that was warranted.
Any thoughts?
Well, I mean, on my side, he knows that I was one of the main critics of the whole thing. I personally, like, at the moment, I'm fine with it. Like, Spark is also given a different path compared to a few months ago, where they are really strongly focusing on growing DAI mostly. So at the moment, I don't see direct competition between Aave and
We'll even
Spark.
allocate to Aave.
Yeah.
Yeah.
So at the beginning, I was a bit annoyed of the whole thing personally. Again, that's a fully personal opinion. I didn't like the way the thing was handled on the governance side. In my opinion, it was not clear what was going to happen. And we have been working with these guys for a long time, like since like 2017, 2018. Like we were building DeFi and DAI was not available yet. That's when we started working. So that annoyed me, but like, you know, things pass, water goes like under the bridge and things evolve, so yeah.
So what license will Aave v4 be under?
Wow. 5 years BSL, that's the minimum.
5 years.
No, just kidding, I don't know, like the governance will decide.
Cool. I think we have some time for audience questions, or we have more time for questions? I have one more question.
One audience question.
One audience question is okay.
Not too many.
Not too many? Yeah. There's one there.
Hi. So in terms of different positions related to immutability of the configuration, like it exists in Morpho, and some part of management which could happen in different protocols, I'm wondering how you're going to solve the case when, for example, users could be locked if the market conditions would be changed pretty fast. Because basically it's all the game if you want to explain all possible cases to users. Your explanation could be a little bit longer than in terms of use of Apple. And I want to ask, who read all terms of use in Apple device or iPhone? I think nobody here, because it's like a 50-page of low legal text. And if you start to talking more about things that in case if the risk curator set up the interest rate not correctly and the market change, your funds could be locked for a few years. So, and in this case, people could come and ask, I do not underestimate that it's possible. So how to really break this user perception that people could be able to lose their money for a long period in terms of deadlock, or do not ask them to read a 40-page terms of things like it happens in Web 2?
Right, so I just want to make sure I get the question right. So you're asking, in the event where you break the risk profile into immutable micro-primitives, in the event of one primitive going wrong, and like lenders decide to withdraw, and so what was the and so then the question is, what happens with this given market, like, or just want to make sure I get this correctly.
It's not a market. It's like so basically when people come to DeFi or blockchain, they should be at least tech savvy, because it's really not the best experience like you register by mail, which was confusing when it started. For many years, people could not understand how to do that. In DeFi, you should have ledger, maybe safe for security, then you should understand how it works. And then there are use cases which you do not expect. Yeah? So if you want to build a protocol which could be understandable for average user, you should really explain all possible risk. For example, if this price will going down or up, and people are not willing to take their money back and close their leverage position, we can do nothing regarding to immutability of our settings. So you should be ready to forget for your funds about for 50 years. And when you will be an old fellow, you can get an access, luckily, to them. Yeah, so it's a case which possible. I do not tell it that it could be here, but me as a user, if I'm not a very deep in lending, I should have a clear picture how it works before making a decision to provide my money to some particular DeFi primitive. And because it's immutable, it's create like a deadlock for a long period of time thing. So how you're going to explain for end users, or these immutable pools for only tech-savvy profis, like maybe 10 in this hall?
Yeah, so first, like, I completely agree that at the primitive level, if you're lending, you have to fully understand what's the full risk of like a given, primitive, right? And by the way, Morpho's frontend, like Morpho Blue's frontend, that we host as like the Morpho Association, does not give you access to the lending market directly for these specific reasons, right? Because you could have like one market with one specific issue, and it's fairly complex, especially on the lender side, less on the bar side, but the lender side is very hard, right? And so you have risk managers that are doing the job of both aggregating liquidity in case of like, if there is one market specifically that gets into a deadlock, as you described, then you have like, 10 different other markets that you get liquidity from. And then the rate of the other market will spike, eventually triggering deleverage. I don't know if that's going to take like 40 years, given like, I don't know if you studied like the specific interest rate model curve that we have, so it should be much like, shorter than that. But yeah, and the other thing is that the primitive in itself does not specify that oracles, for example, are immutable. Oracles can change, for example, like Chainlink in itself, changes the way they price things, not always, but it depends. And you could also have like upgradable instance of the oracle specifically in that case. I don't know if that kind of answers the question.
Can I add something?
Yeah, of course. Go.
No, I just want to say that, it's a hard problem. This we have seen it happen. It happened on Aave. It happened on at some point there was huge market demand, and like someone borrowed up the whole liquidity, or there was I don't know, for example, I remember the CRV thing, in which at some point people were thinking something would happen, so they start panicking. In reality, nothing happened. In general, I think that we should approach decentralized finance. It's like self-custody, right? Mm-hmm. Self-custody, if you mess up and you sign a transaction or a message that can drain your whole wallet, you have nobody to complain to. And this is the pros and the cons of permissionless networks and permissionless finance. This can happen in traditional finance as well. You can buy a bond, and the bank disappears tomorrow, and your money is gone, and maybe you get something from the bankruptcy procedures in 20 years. So it's exactly the same thing. So I do think that we should do better, like trying to improve, like in terms of for people that are not tech savvy, to understand like what are the potential risks. It's not easy, I would say, to do so, because like there is a whole bunch of technology behind it. And I think like things will improve also over time, but I don't think it's a problem that we are going to 100% solve, because it's a financial problem that happens also in traditional finance. It's not specifically specific of decentralized finance.
Yeah. Awesome. I think that's us.
Yeah.
Thank you.
Thanks, everyone.